Hi everyone, welcome to Peaceful Investor. This channel is about simplifying investing and achieving financial freedom. Before we start, I'm not a financial advisor. Everything I share is for educational and informational purpose only. Please do your own research and consult a professional before making any investment decision. Yes, so today I'm going to explain about a company called Portillo's. Portillo's is a restaurant chain famous for Chicago style hot dog, Italian beef, sandwiches, burgers, and chocolate cake. Started from a small hot dog stand in Chicago. Now it has 95 locations across US. Their business model combines dine-in, drive-through, takeout, and delivery. Portillo's focus on expanding into new markets like Texas and Atlanta with new efficient restaurant formats. And by the way, I have invested some time ago in this company and they posted their quarterly earnings yesterday. So I am going to present few of the highlights in their earning. So in Q2 2025 performance, their revenue has gone up 3.6%, 188.5 million, and their same store sales was 0.7%. Their operating income was 17.5 million, net income was 10 million, and their restaurant level adjusted EBITDA was 44.5 million and their adjusted EBITDA was $30.1 million. So, in the next slide, so the two quarters added together, and their revenue growth was 4.9%, and the revenue was 364.9 million, and the operating income was 27.9 million. So in the second slide, they have combined Q1 and Q2 financials together. And in the next slide, as I explained, that this is a fast growing restaurant chain. So they went public in 2021 and they are opening restaurants, 10 to 12 restaurants every year. And in this year, they are planning to open 4 to 6 restaurants in Q3 and 6 to 8 restaurants in Q4. So their fiscal year 2025 financial targets. So the unit growth, which is number of restaurants. So they are planning to open 12 new restaurants in this year. Their same restaurant sales is gonna be 1% to 3%. So if you don't know what is same restaurant sales, it is a metric when they compare two different restaurants together, and they see that if their existing restaurants, not the new ones, if you compare them, is their revenue is going up or down. So their target is 1 to 3%, which is positive, and the revenue growth for this fiscal year, it's going to be 5% to 7% up compared to last year. So by the way, before we move forward, let me explain that in the Q1, when they posted their Q1 earnings, they were expecting 7 to 10% revenue growth, but in this quarter, so they are being conservative. So they are saying that growth it's not going to be that great, but still it's going to be 5 to 7%. And for their long-term growth, so every year they are expanding 12 to 15% restaurant counts. So it means there's a huge growth opportunity. Same restaurant sales, low single digit. Revenue growth mid-teens, which is 14 to 15% every year. That's their long-term goal. And adjusted EBITDA growth is going to be in low teens. So this can be a very good investment for the long term, not for 1 year, 2 years, maybe for one decade. In this slide, if you see in this quarter, their revenue was $188 million and their operating expenses was $143 million. So which was 76.4% of their total revenue. If you compare to last year, same quarter, it was 75.5%. So it means their total operating expenses has gone up. So as an investor, you always want to see the expenses go down compared to the last year, but this is a red flag. And their operating income, if you see, it's 17.5 million, which was 9.3% of their total revenue, and the last year it was 10%. So as a result, their operating income was gone down. So this was like something that you're not going to like it if you invest in the company. So I try to dig deeper to understand why their expenses has gone up compared to last year. So here, what I found. So yes, so the Portillo's management has said uh, the the food cost has gone up. So the commodity prices has gone up by 1.9% due to inflation, and their labor cost, because they are paying more to attract and retain employees in competitive markets, so that's why their labor cost has gone up. And plus, as I explained before, they are opening new restaurants, so they need more staff for that. So they are hiring that staff, and that's why this cost has gone up. And with the same time, occupancy and utilities like all the rents, bills, insurance costs, everything has gone up. And their general administration cost, that's also gone up because they are advertising, because they are expanding into the new markets, so they need to aware people, so this is the extra cost. So when you combine all this cost, it squeeze the profit margins. And at the same time, compared to last quarter, their traffic has declined as well. So it means they got less customers compared to last year. So it could be any reason, high mortgages, cost of living. So because it's not only with the Portillo's, it has seen with the other US restaurants as well. And in this slide, so position of their balance sheet, they have got 16.6 million cash on hand, and the current liabilities is 171.3 million, so which is 10 times of their cash on hand. But this 16 million, this is only for this quarter. So this business is cash flow positive. It means they are generating positive cash flow. So if they keep um, getting the positive cash flow in the next two quarters, so this liabilities can be manageable. But still, this is one thing that everybody needs to be aware of. And yes, again, they also have taken 70 million new debt in this quarter. They already got the debt, and because when you expand 10 to 12 restaurants in a year, so you need to spend a lot of capital, and that's why they have taken the debt. But again, if you go in the next slide, if you see the valuation, so it's trailing PE of 21 times. It means every year the earnings they produce, you're paying 21 times to buy their share. And price to sell, it's 0.70. It means you're paying 70 cents for every dollar they make. And their PB ratio, it means if you pay out all the liabilities and whatever the book value you get, you're paying 1.11 times. So how you can understand this slide? So as a growth company, this valuations is very, very attractive. So it means this company is selling in a very cheap price. The one of the reason is when they posted the earnings yesterday, so the stock dropped drastically because the shareholders, they didn't like what they have posted, because they were expecting revenue to go up more, but it was only 3.4% growth. By the way, I'm not buying or selling any of my shares, so I'm just keeping an eye, and I will decide later what I'm going to do. But I think I'm gonna stick with this company because I see this valuation is very attractive. I think I am going to buy more shares. And yeah, that's it for today. And hope you like this video. If you like my effort, so please do subscribe and like my channel, and also post some comments. If is there any stock you want me to explain it for you, I would love to do that. So thank you so much.